But let's welcome on board the management of Suprajit as well. We've got Ajith Kumar Rai, the founder and chairman, joining in on the show right now from the Suprajit Group. Mr. Rai, great to have you today on ET Now. Thanks for your time. Just, firstly wanted to understand about your Q2 numbers because there are some hints of weakness there. The core margins did manage to hold up. Tell me how the SCS Germany acquisition panned out and whether that impacted your numbers.
Good morning, and thank you for having me on your channel. Yes, indeed, the results, what you have seen in our disclosure, has been impacted largely due to the SCS acquisition. As you all know, this is acquisition out of insolvency. So the entire cost of acquisition, as well as certain write-offs that we had to do upon acquisition, have all been done. So that has been the one why the number seems to be down. But if you look at the individual elements of our 4 divisions, I'm happy to say that each one of the divisions has actually done exceptionally well. Particularly Controls division has more than doubled its margins, which is what our target was. Even the local Controls division in terms of the cable division of India has done exceptionally well. So has Phoenix Lamps and the Electronics division. So the 4 divisions by itself in the quarter has outperformed our own internal targets. The SCS acquisition and the acquisition related costs have been the ones which have had its one-off effects for those consolidated numbers. But if you see the standalone number, it would show a significant improvement over the last year.
Okay, good to know. What is the outlook then with respect to the kind of ongoing restructuring as well that you're seeing? What are the expectations when it comes to your margins? What will be the factors that will drive your margins, and do they look sustainable at the current levels?
The SCS acquisition is only half done. The other half will be done in Q4, as we have said. That part of the business, which probably forms less than 20% of our overall business, will have an ongoing restructuring happening, which would add obviously to some of the costs. But as far as our main 4 divisions, the Controls division, the domestic cable division, Lamps division, as well as the Electronics division, they will continue to outperform as we have targeted in the coming quarters as well.
The SCS acquisition and the way it will add to the cost, but what about the profitability and the kind of accretion it will have on the bottom line? Any clarity on that?
Yeah, as we see it, as I said, for the next few quarters, let's say 2 or 3 quarters, we should be able to get most of the things back into the normal operations. So once the China-Canada acquisition is completed, which is actually a profitable part of the business, I think that would be, a bit of positive. The challenge for us is to turn around the SCS Germany and related entities, which is what has been acquired already. And that's what the negative number that you see, that part of the business. So in the next 2 quarters, I think we should have a reasonable control on these costs, and the restructuring, most of it would be done because the restructuring include multiple things. One is, of course, relocating the warehouse from Germany to lower cost Hungary. There's an issue relating to scale, closing down Poland, which is part of our responsibility. That will add to the cost. And of course, streamlining the Morocco operation, which has scaled up significantly. All these activities should be completed in the next 6 months or so. I think by that time, all these one-off costs will be eliminated from the P&L.
But then what will it mean for the margins? If I have it right now the consolidated margin is 13% thereabouts. Once all of this integration is away, let's say 12 months out, as you pointed out, what would the margin picture look like? Could it be 15, 16%? Could it be higher?
I think on the domestic business, the India part of the business, what you said is easily achievable. I think on the consolidated business, we have said that we will be anywhere between 11 to 12 to up to about 14 to 15%. That is the range that we have guided. And we are at the moment is at 12% without the SCS. And I think with the SCS, it will be slightly lower. But I think post this integration in the next 2 quarters, we should get back to 12, 13% margins.
Okay. And what about your international markets as well? Europe, USA and China. What is the outlook for these regions? There has, of course, been the recently elected Donald Trump. Does that change things for you in the US in terms of policy shifts that could impact the industry as a whole?
I think, businesses outside of India is actually, in terms of the OEM business, it is not really growing. Both Europe and US is more or less on a flat curve. But however, we have grown our business in those markets. So despite the market weakness, we have grown. But in terms of the change of leadership in US, I think, we have heard so much in the campaigning phase. But when they actually are in the saddle, we have to see what is the actual activity that will take place. So it's anybody's guess actually. But the advantage for us is that we are in multiple regions and multiple areas. We are able to offer onshore solution to customers, nearshore solution to customers, and far off solutions with cost advantage. So based on what is the tariff region at that time, we'll be able to act accordingly to meet the customer requirement in a most optimal way. I think that would be Suprajit's advantage in the global markets.
You've also spoken about, exploring future acquisitions. Can you give us a little bit more color on this? Anything that you've zeroed in on, what the overall capex here would be, and any timelines in mind?
I don't think we have made any comments on any new acquisitions. We don't have anything on the table, and there's no plans to do any acquisitions at this moment. We are yet to complete our current acquisition. I think the target is to complete it and integrate it well within the Suprajit Group and the controls division. I think that is our target. We have no other plans at this moment.
I think you have maintained the fact that you're looking at a double-digit growth going forward. If I have it right, this quarter the growth was around 9% on a consolidated basis, excluding SCS.
Yes.
The full year number, can it be closer to, let's say, the mid-teen level of 13 to 15%, or will it likely be 10 to 12? Give us a bit more color around that, please.
Yeah. When we said double digit, we actually meant, including all our acquisitions and whatever organic growth. So from that perspective, we are already in the double digits. But I think going forward, with the additional tranche of China and Canada happening, double digit growth for this year and next year, I don't think it's a problem.
Okay, so double-digit growth is not really a problem, and you're expecting margin profile also to inch up as and when, the acquisition integration does take place. Thank you so much, sir, for making time and speaking with us today, Mr. Rai. Good speaking with you about the business and the way forward. A quick look at the...
If you like this video, then like, share and subscribe to ET Now.